Good morning to SuperReturn. We're pleased, I think, now to start the LP panel. And I'll just take it on from here. So my name's James Newsome. I think this is about my 10th SuperReturn moderation conference, and it's good that the private markets are still going well. What we're discussing now, of course, often at the conference is what everybody is waiting for, which is what does the real money actually think about the market? We have two topics today, really. Well, they're the same topic, but divided in half. First half, we'll talk about the market and where we think it's going. And secondly, much more specifically about manager selection. So I'm pleased to say that I have three important people for both of those topics. Andrea Ash from Railpen, which of course is a prominent UK pension fund. Ramesh Yesodharan from Sumi Trust, who has been looking at the European, I think responsible for the European manager selection for that entity, and Urs van Büren from StepStone. And I'll now quickly just ask each of the panelists to just summarize, in sort of 20 or 30 seconds each, what their role is in those organizations and what they're tasked to do in the market. Andrea, start with you.
Thanks, James. Well, good morning, everyone. Many thanks for having me here, SuperReturn. So my name's Andrea Ash. I'm an investment director within the private market team at Railpen. As James said, Railpen is a UK pension scheme which manages the assets for the UK railway networks. We run around 30 billion sterling. I sit within the private markets team and, amongst other things, look after our private debt investments.
Ramesh?
Hi. Good morning, everyone. I'm Ramesh. I work with Sumi Trust, which is a Japanese bank. I work as a structured credit portfolio manager looking at the high yield loan space. So taking exposure to this segment through direct loan fund exposures, CLO AAA bonds, as well as through direct lending LP investments. So besides coming to the direct lending funds, of course, I look at the European LP investments. In addition, we work with Japanese institutions as gatekeepers when they allocate into the European direct lending space. So that's my interest in this space.
Oh, great. So going from UK all the way to East Asia. And in between, we have Urs from Zurich at StepStone.
Yeah, good morning. My name is Urs van Büren. I'm a partner at StepStone Group, a global asset manager that focuses on 4 asset classes in private markets. That's private equity, real estate equity, infrastructure equity, and private debt. In private debt only, our clients are trusting us to advise and manage more than $25 billion. And we approved new investments for just about $6 billion in 2019. I joined StepStone in 2009 after more than 20 years with UBS in Switzerland and London. I'm responsible for all private corporate debt investments at StepStone.
Okay, great. So let's get into the topics. Good that we have a mixture here of you, Urs, representing your own opinion, StepStone's opinion, and your client's opinion. And Andrea representing your own opinion and Railpen's opinion, and Ramesh likewise, perhaps also some third-party views as well as your own views. Actually, Ramesh, let me start with you. So just quickly, I'd like everybody to summarize, which has happened throughout this conference so far, just summarize where you've shifted perhaps the way you're looking at markets this year as this crisis, as we have to call it, has developed. So just summarize quickly what has been going through your mind differently to what would have happened if we hadn't had this crisis.
I think, honestly, there hasn't been much change in the investment approach. Coming into the crisis, we had a late cycle feel to the market. So we were looking at established managers, looking at large managers with experience in restructuring and track record through cycles preferably. So as regards our approach to direct lending itself, it hasn't changed much. But clearly, we come out with the conviction that private debt is only going to increase. The alternatives are only going to increase after the crisis. And in the initial few months, March, April, May, our focus was in trying to understand the implications of COVID and the lockdowns on the portfolios. I think we are past that phase, and we have continued with our investment activity. But at this point, we don't have flexibility to do stressed or distressed. So that has meant our investment activity is almost unchanged.
But are you happy with the level of discovery in terms of how portfolios are really holding up? Are you happy that there is enough transparency to know where to allocate?
I am definitely, it's a story of mix, to be honest. Some of the managers, clearly we have had very regular calls and regular information coming through. So clearly we are comfortable with the extent of disclosure there, as well as granular information. And some of the other managers, even the approach on their assessing credit assessment, how to somewhat they have been blazed about the impact on these borrower companies. So we are seeing some distinction within managers, but by and large, I would say we are quite pleased with the proactive approach from the GPs of information disclosure and giving individual borrower information.
Andrea, have you guys, or have you shifted at all in Railpen in terms of your stance on the market, or like Ramesh, is it continue business as usual?
No, we actually had quite a bit of a pivot. So pre-COVID, we have a really nice lending book within our debt portfolio. So pre-COVID, we were actually very focused on the strategies outside of the lending space. But safe to say that post-COVID, that's changed somewhat. Part of that is due to Railpen have a really nice, strong, stable capital base. We obviously want to generate good returns for our members. Equally, the other side of the table, there are a lot of companies out there who need capital at this point in time, and that's likely to increase as we go into the next cycle. So we really try to take more broadly a view that we want to, how can we be part of a solution to this problem? And obviously within the debt space, lending is one of those areas. However, we haven't really focused on the traditional lending space. So what I would call kind of your par lending, that's kind of green. There's obviously been a lot of opportunities in more distressed types of sticky situations. We've really been trying to find stuff that's kind of in the middle, which hasn't been that easy. So strong companies that outside of COVID otherwise would perform very well, would have had an abundance of capital coming from the traditional par lenders, but perhaps over the next couple of years are going to find it a little bit harder to source that liquidity. So that's the area that we have been trying to slot into. Again, it hasn't been that easy because there aren't that many people that focus on that area, certainly here in UK and Europe. So
that pivot, that slight pivot to where perhaps the supply and demand for credit is in your favor. In other words, you feel, as you say, that companies need credit. Is that because you'll get higher returns, or because you think you'll get more conservative deal structures, or both?
Yeah, no, as I said, it's really coming from the fact that we've been trying to think, okay, of, where kind of needs our capital most. Again, we're trying to be a little bit more of a solution rather than trying to take advantage of of an otherwise difficult situation. The returns are higher, but they should be high, because again, it's again, probably stickier situations than the traditional par lending side. But that's not, I have to be honest, that's not what's been driving the focus. So it's more philosophical than that.
Yeah. Okay. So Urs from StepStone. I will say people's companies' names every now and then in case people arrive late. So Urs from StepStone, tell us, what's your overview at the moment, sort of top down, about the private credit market?
Yeah, the menu overall has not really changed, but certain dishes are certainly more in season than they have been for 7 or 8 years before. we spend a lot of time discussing opportunistic and distressed strategies. The former is more imminent and concrete, like Andrea just alluded to, with return expectations in a 10 to 12% range. The latter is more universe, GP selection, different sub-strategies, because it hasn't really hit us yet, but one needs to be ready, one needs to make GP selection, and it will unfold over the next 2 to 3 years, we believe. So getting ready on that end. Additionally, some requests on less correlated strategies, like legal claims, royalties, NAV lending. NAV lending is something that really just is pretty fresh. A final point to make, very few of our clients are as well invested in direct lending as Andrea's firm. So they're still focusing on still getting and build the exposures they're actually seeking, while adding one or the other satellite investment to it. So the main focus remains on traditional direct lending.
Yeah. Okay, so with this being the, it seems like the consensus then is that everybody sees direct lending. In fact, we read this every time we read something from either Financial Times, the mainstream media like the Financial Times or Bloomberg, through to the technical press in our world. There seems to be a cozy consensus, which is sometimes worrying, that private debt is going to increase and it's going to become more important. So just quickly from, maybe start with you, Ramesh, to what extent is this really permanent in your guys' mind as an organization? Is it a function of low interest rates? Is it a function of maybe government stimulus, or do you see that as a real secular shift, which you and your clients will be committed to?
Yeah, I think, both supply and demand in a sense. So supply side, clearly, we see banks had been challenged in mid-market lending segment for a while now. And the current crisis is going to accelerate that trend. And though for the immediate future, all the liquidity schemes might help the banks, but definitely capital constraints will become prominent, and the gradual withdrawal of banks from these segments will continue. On the demand side, clearly you have whatever number of trillions of negative rate bonds, and clearly we see pension and other insurance companies, etc., demand for alternatives increasing. So when we look at this segment, what we have seen in the, let's say, the broadly syndicated liquid loan market, 10 years back, 15 years back, it used to be dominated by banks, and now banks form 10 to 15% of that market. So that is what we expect to happen in the mid-market segment as well. So that's why we have been spending time trying to research this segment, both for our LP investments, but more importantly, to position ourselves to support our clients who want to allocate to this segment.
And thanks. And Andrea, so for Railpen, is this a structural thing about the asset class? It's 10 years, it provides income, it matches your liabilities, therefore this is a permanent focus for Railpen, or is there a cyclical aspect to it for you guys that rates are low and it makes sense for now?
Yeah, so I mean, as a pension scheme, we're obviously always looking long term. We have where our private debt sits within our portfolio is very much focused on long term opportunities. We have another part which is really trying to take advantage of particular tailwinds or areas of disruption. So that's not necessarily falling into what I'm talking about here. This is very much for the long term. I'm not, as you said, there's been a huge flow of capital into the space over the past, I guess 5 to 10 years. I'm not sure that we're necessarily going to see the same now. I mean, there's nothing like a crisis to shake up a market. So I think that you will start to see a divergence between players. I think we're very much at the beginning of that process. So it's far too early to say. But yeah, I think the supply demand is going to shift, although I do agree with what Ramesh was saying, and the fact that this is going to be very much a non-bank kind of trend, which has been in place and is going to continue. So,
and is there, as a non-bank trend, might there be some unforeseen risks from regulators or from in that the private markets may be seen as, the fees are too high, or the fees are not transparent, or the way we calculate IRR is somehow misleading? And do you think there may, for Railpen planning longer term, do you ever worry about the political context to private markets and how it may be disrupted?
I mean, we always have to consider the regulatory environment, regardless of what we invest in. We have a financial services strategy, which is completely asset class agnostic, but obviously open to huge, regulatory elements because of what it is. I think that where you have a huge part of the economy that's being financed by non-banks, unregulated entities, then yeah, it's something you have to be aware of. Where that goes, I don't know, but yeah, it's something we absolutely have to be aware of. So.
Yeah. Okay, so Urs, from a StepStone perspective and a StepStone client perspective, this show will continue despite the crisis, and it remains this private credit. Actually, let me ask you a more specific question because I think you guys do private equity as well. First of all, do you see private credit as a permanent fixture now for clients, and also how do you see it in relation to private equity? Because some predictions are that ultimately it would be a bigger market than private equity.
Yeah, I was just actually starting with that. The private equity is expected to grow. They will invest money, and they raise debt to finance their investments. That is, if one doesn't believe that, then obviously one can question whether private debt is there to stay. But I think private equity will continue to grow. So there is demand for that. Who does it provide it? It's banks, it's institutions, it's non-bank lenders that arrange it. We believe the banks will further reduce, but ultimately they remain a player. One can also work with banks, which a lot of people have started doing. I think the real test is now in the next 1 or 2 years, whether the expectations on realized losses are within expectations, and that is the real test for the asset class. And once this can be proven, it's not only the last 7, 8, 9, 10 years which were all positive. Through a crisis, the losses are not beyond expectations. The trust will grow further, and institutions will increase allocations because they need the yield. And where the debt comes from doesn't actually really matter, whether it's banks or non-banks or directly through large institutions. It will be arranged somewhat.
Yeah.
There could be clubs of large pension funds coming together and lend to companies. But that's a bit down the road, but that will always be needed.
Yeah. Okay. So that's the big picture. So now homing in a little bit, let's have a look at the manager side of the equation. Then we'll come back to more specific strategies after that. So Ramesh, and I know that you've been looking at managers in the European direct lending space, perhaps both the broadly syndicated world and the mid-market, and maybe even lower mid-market, I'm not sure. What would you identify as 1 or 2 real differentiating success factors for managers? What have you come to notice as being things that you respect in a GP when you're looking at different managers?
So yes, we have looked at both the liquid loan managers, CLO managers, and all kinds of direct lenders, from the large to mid cap, all the way down to lower mid cap. So clearly, we have been focusing on the larger managers, their 4th fund, 5th fund, who have established restructuring track record. I think coming into this crisis, two things clearly have become important. One is the managers positioned or adequately staffed to very quickly get on top of the portfolio and gather information about the impact on the underlying borrower companies, grade them into red, yellow, green, etc., and identify the impact on liquidity, on profitability, on solvency, etc. So how are they adequately staffed to do portfolio review of implications of COVID and lockdown, and whether they are communicating this in a granular information and in regular manner? I think that's one aspect in which we are able to now differentiate between managers. We have seen managers who have GPs who have been quite systematic in having these monthly calls with easily understandable reports, etc. And second thing, of course, is the kind of restructuring experience they have within the team, whether they are able to have they taken over companies in the past and have they maximized the recoveries through those approaches. I think these are the communication and the restructuring track record are something we have been focusing, and this crisis has helped us differentiate managers on these two parameters particularly.
And have you seen any patterns as to which types of managers fulfill these criteria for you? Do independent managers who maybe started as private debt specialists and just grew on their own, do they seem equally capable to managers perhaps owned by large insurance companies or managers that are part of larger private equity groups? Have you seen any patterns there, and do you have any preferences?
Sure. Not as much from the in terms of where the manager originated from, but more specifically, it has been the kind of experience the managers have had. Are they coming from the large cap and focusing on more syndicated, or I would say relying on banks for origination, or are they direct lenders and have been working with PE sponsors, etc.? So I wouldn't say honestly that we have been able to distinguish based on whether it's a PE-backed direct lender or is it an independent house. But generally speaking, I would say the larger managers, larger GPs have been able to update LPs on a more frequent basis and in a systematic manner.
Okay. Feeding in a question from the audience, which I'll ask you now because it's on this topic, and I'll ask the other two panelists to address it as well. And the question is about whether you are likely to want to re-up with a smaller subsection of managers now. So for you, Ramesh, I know that you're relatively early in the process for you guys, but do you think that are you likely to want to find 1, 2, or 3 managers that you will repeat investment with, or are you looking to diversify across a wider section?
I would, because we are early in our deployment phase, I think we would like to diversify. Clearly, we want more, not just portfolio diversification benefits, but also we want perspective and understanding of how different managers operate and how they originate, how do they communicate portfolio updates, etc. So simply from that perspective, I think we would look for diversification approach to start with.
Okay, and Andrea, I know another UK pension fund which has had a strategy of really having, I think, 5 or 6 managers which they've done repeat business with, and they've been happy with that. Which way would you go? Are you looking to diversify or find your friends and stick with them?
So we try to find partners that we can work with in particular areas. Now, I mentioned earlier on we had a really nice portfolio of lending strategies. They were very different strategies. So we had specialists in different areas, but they were broadly lending. So we do have a portfolio of them, but again, they're all doing quite different things. But generally speaking, we are looking for partners that we can work with over the long term and have kind of a go-to relationship with them in specific areas. So we're not really looking to diversify across corporate lending, corporate sponsored lending, for example. We would rather have one partner and work with them.
And would you point to, so back to the original question here, which is of course on our agenda for this call, would you point to any success factors that you would consistently respect in a manager when you're selecting them? And Ramesh mentioned, constant information flow between them and their assets and between them and the investors. What else would you point to?
Yeah, no, absolutely. We work with new managers and we work with very established managers. For us, though, the one thing that we're consistently looking for, again, is that type of relationship that we can have with them. The transparency obviously forms part of that. It's not just about how much they put in their quarterly letter. It's being able to have a conversation on an ad hoc basis with, a key risk manager, whether it's the CIO, whether it's the lead portfolio manager on a particular area. It's being able to introduce them to other parts of the scheme. We look at everything kind of from public through to private, liquid through to illiquid. And there are a lot of kind of overlapping dynamics between those areas. So again, trying to look at them more from a business perspective rather than just an individual strategy perspective. So
yeah. Ramesh mentioned restructuring experience within the team. To what extent have you actually seen that, though? Because, of course, we've had quite a few false dawns on the distress side, 2012, and everybody raised money, and somehow there haven't been any defaults. So who really has restructuring experience? I mean, you've got to be like 50 years old or more. You've got to be my age to have been through the last crisis.
Yeah, so I have to say within the lending space, again, I work with some first-time managers, generally outside of the debt space, but within the lending space, I have to say, being able to have that kind of portfolio monitoring, that restructuring type of expertise. I've said this in previous panels. For me, is extremely important. It hasn't been that important to date for the reasons that you said, but I think this is where you're really going to start to see that expertise come into play. When companies get into trouble, it can become a full-time job trying to look after them. You are effectively, in some instances, becoming almost kind of private equity turnaround type people, right? Yeah. So trying to underwrite new business in what is potentially a very lucrative environment and trying to do that on the side is going to be a real stretch on resources. So it's not just having the expertise, but it's also having dedicated resources to be able to do that. I think you will start to see as again, divergence between managers, and that might be one of the factors.
Yeah. So Ursula, you have, just quickly describe it to us now, because it's interesting. You have this process within StepStone where you don't formally commit to a manager. You make sure that when the manager does have capacity, you will then invest with the manager. So very briefly explain that to us, and then please address these points about what you see as the success factors in different managers.
Yeah, briefly, we take client money from institutional investors, and they commit to us, and then we have more than 30 managed accounts underneath with 25 different GPs to which we allocate these monies, and the reason why we don't commit to the underlying managed accounts or GPs is that we can shift from one to the other, because a single client usually has 8 to 10 underlying managed accounts. And if we, let's say, allocate to 10 and to 10% each, they will never ramp in parallel. After 6 months, one will be ahead, one will be behind. Couple, actually, usually more are behind. We can shift these allocations to get the result of the client being 90% plus invested within 12 to 15 months and stay there. The efficient reinvestment is obviously super important too. The only aim is to get the client invested and stay invested and keep on generating that yield they're seeking.
Because if you were to turn up with 300 million for one GP, you can negotiate on fees and other things perhaps. So if you spread across managers, you're happy to perhaps have less negotiation power, or is that not the case?
Every managed account has the aim of 300 million or more from day one. So the negotiation power per se is given. We aim to deploy that usually over 2 to 3 years with a GP. So it is a mid to long term relationship in any case. So the negotiation power should basically pretty much cover what we charge. So it's not no extra costs to investors, unless they're very large themselves and use us for different reasons.
Yeah. Okay. So on the topic of what you look for in success factors at the moment, perhaps particularly in this time in the market.
I think in addition to what's been said so far, is the behavior of the teams, the experience of the teams, because while everybody has a lot of experience in lending money and sorting out issues, etc., the LP component is important. If a team is new, has never dealt with investors before, screaming down the phone, what's going on in my portfolio? I want this information, while having to work on all these troubled credits, because everybody has some, that may actually, within the team and the dynamics, change results. So we're quite focused on that, and that the governance is maintained. So operational due diligence, we did a full review between April and June of every single manager we work with, just to make sure we have the basis and identify things we want to monitor. So team dynamics, very important, because we only chose GPs that have the experience, etc. But now under pressure, there may be changes.
Yeah. Okay, so now for the last, so there's a question from the audience, which actually is good, because this is what I was going to ask you guys, which is now going back in a little bit into specific strategies. So the question here is whether people see sustainable LTVs and leverage levels. So more of where the relative value might be in subsections of the market. So Ramesh, have you seen, you said that you've looked at both the smaller cap and the large cap. Just generally, where are you seeing the best relative value at the moment, and perhaps addressing these questions about leverage levels and deal terms?
Yeah, I think post-COVID, we haven't really seen much of fundraising and can't see the impact of COVID on the larger end and the smaller end yet. But post-COVID, clearly, there was a hope that the pricing would be better by, let's say, 100 plus basis points. The documentation would be much improved and leverage would be lower. But those expectations are now being dialed down, definitely for the mid-cap segment. I haven't seen the trends in the smaller end of the market to see if they have sustainably improved or not. So that's my perspective.
Yeah, and so Andrea, you say that it's interesting because your perspective is philosophically slightly different, in that you're deliberately looking for places where the supply and demand for credit is very much in your favor, without saying that you're doing distressed. So in terms of leverage levels and deal characteristics, is there anywhere that you're rather avoiding and you're seeing things as being too risky?
I think it's a little bit early to say on that front. We're definitely not looking for distressed situations. Again, this is about kind of strong companies that would otherwise be strong, but have come into trouble through COVID. We can all think of some very strong companies in sectors that have been particularly hampered. There's nothing specific at this point. As I said, we've actually found it quite hard to find managers that focus on that area, full stop. So trying to get any kind of deal level data for that area has been very hard. So it's something that we're currently looking at. Now, obviously, the risk is going to be a bit higher. It's probably, I'm imagining that we're going to see companies that have taken, a jump that would, as I said, kind of traditional, kind of on the meeting everyone's expectations pre-COVID, but are going to have over the past 3 to 6 months suddenly taken a little bit of a jump in terms of leverage levels. But equally, therefore, there's going to be should be a pickup in returns. The one thing that I would say as well is that I'm hearing from different managers within across the private debt space, and not just in the lending space, that it's not just about returns either. again, it's quite early on, and I see us very much at the beginning of the cycle, but returns are picking up a little bit, so maybe, a point or two. But the bigger focus has been on the risk. So it's control over covenants, it's around structuring. So what we're really focused on is the risk-adjusted returns, as opposed to just the pure level of returns that we should expect to see coming into this next cycle.
And how do you, just in terms of the way you work, so in Railpen, do you have an independent credit committee that you would go to with private debt ideas and they work across the whole portfolio, or do you manage private debt and these factors, these risk, the emphasis on risk rather than returns? Is that something you've decided within the private debt world, or is that an overall thing within Railpen?
So specifically within debt, so I would look after that portfolio. We have an investment committee which I go to for sign off for investments. So that's the way we work. We have various different governance structures in place depending on what the investment is. So
yeah. And okay, so then for you, are there any subsectors of direct lending that you're less enamored about at the moment? Either the very big deals or the very small deals, or the buyout versus growth or credit?
Not particularly on that. We always have limits on loan to values. They're usually around 60% or 55% for first lien unitranche. So that maybe answers that question. And they're currently rarely hit because the leverage levels have come down a bit. You
measure LTV purely through equity contribution in the deal?
Yes.
Yeah. Okay. And you're seeing that you're happy with equity contributions and how they've held up? They
remain strong. The other challenge, obviously, is looking again. I mean, it's back to what I learned more than 30 years ago. You look at the cash flow model. Can the company actually repay its debt over a period of time, which often gets forgotten, and during periods like this, it comes back up. It's back to the roots. Buy and build is obviously something that challenges things because companies need to grow into their cap structures. But we have limits ongoing. And as Andrea said, risk-adjusted returns have certainly improved because documentation is a bit tighter. And that is certainly an interesting period now. Maybe just to address another question that I saw on second lien and mezzanine, i.e. non-first lien. Yes, we are spending time on this because it's usually an interesting vintage, a year or two after a crisis. Limited opportunities though, because the unitranche, especially in Europe, is really all over. And there's not that as many as one saw in 2011 and 12. So while interesting, the volumes are low and possibly a bit like Andrea said, the number of GPs that actually generate those is not that big. Large cap is an interesting space in that end. Let's say that the Goldman Sachs and other that do multi-100 million non-first lien tranches, they're actually attractively priced if you get your hands on them.
Versus high yield, you mean where they've replaced high yield? Or
exactly.
Yeah. Okay, so very quickly now, which will be fun to put some pressure on everybody. So in one sentence from each of you, please give an advice in one sentence to any manager that is trying to talk to you at the moment and how they should approach you. Ramesh, what would be your advice to GPs when dealing with you?
So talk us about the COVID impact on portfolio and how you communicated with LPs during this last couple of months.
Yeah. Andrea?
How are you looking to work with companies? Again, we're very much focused on kind of the friendly approach as opposed to trying to take advantage of an otherwise difficult situation.
Yeah, okay, this has been clear from you today. Yeah, and Urs, when coming to Zurich, how should managers approach you?
Convince me that you're looking for a diversified portfolio well balanced. You repeat what you keep on doing and stick to your guns. Definitely no style drift. And based on what I hear, we make our assessment. Because credit is boring. Convince me that you remain as boring as it is, while generating interesting returns. There, maybe just an interesting observation. We had quite a few software and IT focused GPs that recently came through video, and they were obviously bragging about how well their portfolios are doing, etc. I always walk away from these kind of smiling. What if it was a computer virus and not a biological virus? Highly concentrated, and we just don't like concentrations. So that's just another point to make, maybe.
A good point. So luckily today for this panel, there was no computer virus. I hope there's also no biological virus for everybody, of course. And thanks very much for sharing your views today.